Hello and welcome to the Market Moment podcast. My name is Eli Freeman. I'm joined with the one, the only, the man, the myth, the legend, John Markfeld. Happy to have you here.
Happy to be here. Great intro. I expected more, but that's pretty good.
I had some more, but we're saving it for later. So today we have several exciting topics, talking about Nvidia, because what else would we talk about? Talking about inflation, because I don't know if you've heard, it's still around.
Yep.
I had someone yesterday tell me that inflation was up 25%, and it was an interesting conversation that they had.
Yeah.
And then one more, we going through several different tweets. So financial Twitter, if you're not on financial Twitter, it's an interesting place to keep up with information. Plenty of bad information out there, but a lot of fund managers are on Twitter, so you can get some pretty interesting tweets, updates through financial Twitter. So I'm gonna kind of just throw a couple out. Hear your thoughts on it, John.
Yeah,
I've got those prepped and ready.
Yeah, I'm ready
at the hip. So first thing is Nvidia stock fell, and is this a correction? So Nvidia stock fell as much as 5% on Monday, as investors rotated out of the hottest AI play of the year, and it has been the hottest AI play of the year. The stock declined more than 11% from its all-time closing high, and its market cap temporarily dethroned by Microsoft. So it had crossed Microsoft, and now it's back underneath the size of Microsoft. The stock's steep climb makes it vulnerable to profit taking, but we argue any volatility is likely to be short-lived, says a Bank of America analyst in a note last week. They reiterated a buy rating and $150 price target while calling Nvidia a top pick quotation. What is it today at the time of recording? Let me pull it up. So as of today,
it was 120 something yesterday.
Yep, 121.08.
121.08. Yep. Okay, so up a little bit today, right?
Mm-hmm. You keep up with Nvidia a lot.
Oh yeah, I love Nvidia. I would say this just creates a buying opportunity. If you get an 11% pullback, but now the stock's up 1,000% over a short amount of time. Yeah. I mean, the stock has been moving. The deal with this stock is that it's the number one in its category, and there's really not any competition. And this sector of the market is the most talked about sector, right? Mm-hmm. The most talked about hot item, AI, all the things that they do. So I kind of feel like, and I saw a price target of 200 for Nvidia. I know this one's 150 from Bank of America, but a different analyst had it at 200.
Sure.
And I could easily see it roaring back to 200. After that 10-for-1 split brought it back down, or ETFs and mutual fund managers made it more attractive to, and small investors, it made it a little more attractive. That's the 10-for-1 split. So I can easily see it getting to 200 fairly quickly. However, obviously, all runs will end at some point, right? I've also heard people say that this is the end of Nvidia. It's going to come crashing down. It's and I don't agree with that at all, just because of its strength in its sector and what it does. And I don't think it's going away for a while. So I think they're in line. Anytime you get pullbacks, it's a buying opportunity.
With Nvidia? What's the long-term profit generator? So there's chips. Is that it, or is there some more parts?
Well,
of the business?
I think it's their ongoing research and development stuff, and they're pioneering. So AMD is a stock that is trying to battle them, right?
Advanced Micro Devices.
Yes, but it's not even close. And if you look at both, if you kind of dissect both, Nvidia has been doing this for about 10 years. Mm-hmm. It's just got the hot traction on the market the last 3 or 4, I'd guess. I mean, it has gone up for the last 10 years, but if you look at the lines, I think 2021, it just shot up like a rocket, and it has done that since 2021. But it's been the leader in its industry for a long time. So to answer your question, I'm not an expert on exactly, because I'm definitely not a engineer
analyst,
or computer science major, anything like that.
You're not on sell side.
Yeah, exactly. However, I research enough of the company to love it, believe in it, know that they're leading, and I don't see that going away. And because of the new frontier of what they are, basically, I know I've heard this saying before, like when we went out and found gold in California, right? We were in the picks and shovel phase. That was the companies that made the most money when it first was, found that we had gold out there, and the rush out there, people were going and buying picks and shovels. So those companies made a lot of money early on. And then it went on to something else. Mm-hmm. We're in the very early stages of this sector.
So you think we're still in the early stages?
I think we are. I mean, if you go back to 20 years ago, And this was not even, we had companies, obviously technology companies. I can go back 25 years ago when I started, before we had an iPhone. It's like technology is just expanding so fast, and Nvidia is on the upper edge, top side of it. And I do think we're in the beginning. I still think we're in the beginning to early stages, and I think it's gonna get more and more impressive, and they're leading it.
Mm-hmm.
So,
and at some point, then after beginning stages, there would or should be some form of movement into other sectors from what NVIDIA is creating.
Right.
The technology that NVIDIA is creating, the reason there's so much hype and so much energy around it is because it should create a more productive economy, more productive companies, more productive people. And
exactly.
If that works, that creates a more productive stock market.
Right. Last thing I'll say on NVIDIA, I bought NVIDIA for the first time for a client about 5 years ago or longer ago. And it was an American Airlines pilot, and she's a high-ranking pilot and flies international, and so on. And she was talking to me. We were talking about stuff and stocks, and she said there was something that they had been working on with the plane or whatever, and she said it had to do with NVIDIA. And I started researching that, and this is well before it did anything. So it
Hilarious.
Sat in her account and didn't move much for a while. Huh. And, of course, we held on to it, and now obviously it's done very well. But it's kind of like it does help other things, and it's going to help other sectors get more efficient and better. And again, not to get too technical, because I'm not smart enough to get too technical about it. I just know I love the stock. If that makes sense. So
anyway. keep in mind, anything that we say, even if we're excited about a stock, that's not individual recommendations. We're not saying go out and buy NVIDIA.
I probably doomed it.
We have no idea what's coming with NVIDIA. But hey, if you like these videos, if you like this type of content, be sure to subscribe. It really helps the channel, gets us in front of more people, and we're hoping that this content is valuable enough that more people see it. It helps more and more people. So hit that like button, hit that subscribe button. Helps us and helps other people. So the next topic that we have is inflation is not the only risk. So San Francisco Fed President Mary Daly, I apologize if I said that wrong, Daly.
I think it's Daly. Yeah, but keep going. Yeah,
Daly said on Monday that rising unemployment is increasingly a risk. The Federal Reserve must exhibit care, that's in quotes, as it aims to finish the job of bringing inflation under control. Reducing inflation further will likely require restraining demand, she said, and while so far the unemployment rate, now 4%, remains below long-run sustainable levels. Future labor market slowing could translate into higher unemployment, and to avoid that, the Fed must be, quote, vigilant and open. Vigilant and open.
Yeah. So this is just kind of like get out of jail free card. In other words, like if you just say this big broad stuff and anything can happen within this range,
and we can make any changes that we want.
Yeah, I mean it just keeps it kind of easy for And I say the Fed has put themselves in a really tough position, and it started, in my opinion. Okay, my humble opinion. I'm not as smart as anybody in the Fed. Don't pretend to be, but in my humble opinion, going back to Barack Obama presidency, Donald Trump presidency, and then now through COVID and Joe Biden, we have had opportunities. The Fed has had opportunities in that time frame to raise rates and to be in a different situation when COVID hit.
In a healthy economy.
Right, in a healthy economy. So I think they kind of made a mistake then, right? And then you fast forward to COVID, and it was a totally different world, and none of us went through it, closing the economy, printing all that money, blah, blah, blah. So it's kind of unwinding something that we've never unwound before. So I think they're in a tough position. And who am I to say they're doing it right or wrong? I mean, again, I have my opinion, but I don't know, and nor does I don't think anybody, because we've not been through it. I just think they're on it's tough. And I'll go on the unemployment and the inflation side. At first, we were told it was transitory. It was just based on COVID or, ships not being able to unload on a dock or something and so on. And of course, that is not true. And when we printed all that money, and it's money, unproductive money that you print, when you print and you pay off companies because you're not letting them work, which is what you have to do, you're putting money in the market that can still spend, but it's not coming from production, right? So that money still spends, so the demand still stay high, but the supply might have dwindled because we didn't have supply chain movements going on. But it's more about the money that was printed. When that ends, which the M2 measure of money supply has told us that we are now out of that free money that's in the market. It's now out of the market, and that just happened in the last quarter. So now we're going to see what happens when we have credit card debt at massive highs, all-time highs, in fact, in U.S. history. You've got U.S. debt at all-time highs, and you've got interest rates. And here's the interesting thing about interest rates. So we want them to fall. We want the Fed to lower them because naturally all of us, for the most part, unless you're a CD buyer, benefit from lower rates, right?
Sure.
And it's in the housing markets and everywhere. Think about this little problem that we're not really talking about. And these are just little things that I see that I think are out there. Interest rates were so low for so long that people locked in their mortgage rates. The lucky ones locked in their mortgage rates some in the twos. I mean, as low as the twos, and some in the threes and fours. And so you're in that 2, 3, 4 range. If you have a house in the 2, 3, 4 range, it's really hard to get rid of it today, because you now have to go if you want to replace it, you're going to have to go pay 7% or higher. So the inventory is going to be slowly, it's not going to be as normal as it normally is, because you don't have that normal market. Mm-hmm. So demand stays high for houses, even if interest rates are high, but it still takes a crunch out of people's money. They have to put more towards the house payment and interest. So it takes less out of the economy. And all these things kind of add up, these little tiny things that we've had happen. And all of a sudden now companies are going to have to pull back a little bit, because demand is going to go down, because money is not going to go everywhere, right? If it goes to more higher mortgage payments or whatever, money's going to go to less to trips or
if we had a significant amount of people purchase new mortgages.
Well, right, which you won't. But I mean, but that is a small piece of a lot of little pieces like that inflation and interest rates and so on have affected. Mm. And I think ultimately it comes down in the end where you will have a tough time. They are going to have a tough time controlling unemployment, controlling interest rates, controlling inflation. And I don't know. I mean, I just see that's going to be a little bit tough. Mm-hmm. I don't know how you get out of it. I have a feeling we have a great country. We're fantastic. We will find a way to fix it and get through it, even if it's a little bit of a troubling time. But there are some, in my opinion, some troubling things out there.
I've said this for a couple of years now. We could see the unemployment rate rise, and that not be concerning relative to history. So if you look at the long-term average, I'm using Y-Charts, which is a software we use that aggregates data for us. The long-term average is 5.69%. As we speak, the rate is 4%.
Well, yes, 4%.
That go into the unemployment rate. And there's parts of the unemployment rate that could be argued against. It has to be people actively looking for jobs that are out of the workforce.
Hours worked as well.
Hours worked is a part of it. So there's some parts of that calculation that could be argued. But to say that we had a 1.9% rise in unemployment, getting back to the average, that's a painful experience, because that would be thousands and thousands, probably millions of jobs that would be lost. I'd have to get the numbers exactly. But we could see millions of jobs lost, and us just be back to average unemployment rate.
Yeah, and you're right. But it also goes back to, like, interest rates technically are about average right now.
Yeah.
Right. And we think, because we've been in this bubble for so long with low interest rates, that we're at this high interest rate inflection point and it's just so bad for the economy. In reality, we're very close. But it goes back to when you've gone through years and years and years of it being better than that, it just is a stress to the system when it goes back to, even if it's reverting back to the mean, right? I mean, it's still, for the 10 years that we've been living in this great world, there has been people retiring. There's been new people in the workforce. So it's just a new group of people that are going to feel pain, that even though the numbers tell us that they're still going to feel the pain, right? But
if you had a machine and it gave you $10 every day you woke up, the machine just spit out $10, and then one day it spit out $9. You just go, what in the world? Why did this just go down?
Number one, I would love that machine, regardless if it gave me $9 or $8.
Hey, so move into some of these financial tweets. So Charlie Balelo, really enjoy him in some of his tweets. He does a good job just summarizing different market cycles and different parts of the market. Market cap weighted S&P 500. So if someone looks at the S&P 500, that's the one we're talking about, is outperforming the equal weight index. So that's 500 companies equally held, not by the size of the company. Right. The market cap is outperforming equal weight by nearly 10% this year. That follows a 12% outperformance last year. Since 1971, the only back-to-back years with a higher combined outperformance similar to what we have today, end of year hasn't come, but we'll see, is 1998, 1999.
All right, this is perfect. So I started the business in 2000, and it was right, and I remember when I first got in the business, an analyst from Edward Jones, came on was in St. Louis, Missouri, and that's their headquarters. But she came on every morning, gave a market outlook, and she said that if you do not own tech stocks, you're stupid, right? And that was in March of 2000. And like a month later, the tech market started falling. But here's the point: that 98.98 segment, 98.99, and then this recent 2-year segment is based on 5 to 7 companies, right? It's based on Amazon, Google, Apple, Microsoft, Nvidia, Meta, and maybe Tesla. But the point is like they're
driving.
They're driving it big time, which is great because technology. This is the wonderful thing about the United States of America. If you look at all the greatest technology companies in the world, they're all in the United States, basically. I mean, there are some obviously that slip in there from other countries, but America leads the world usually in everything because of our technology, and the markets are driven a lot by our technology. So our technology companies are just roaring, and I love it. There is that worry that you will overrun the skis a little bit, and we'll have that pullback. And I do worry about that, and I do think it's not healthy that the other 490 stocks in the S&P aren't pulling their weight, so to speak. But
it's actually been interesting.
But they're doing okay, right?
There was a tweet that I saw last week, and it was one of my favorite analysts, Tom Lee, and he was talking about the breadth in the market and how people are calling it a too narrow of market. And right now, I think the quote was I'm not going to find this for compliance.
Yeah.
It's there's 40 stocks up 30% year to date.
Right.
And it's like to argue that there's no breadth.
Well, that's good. And the year to date is good. If you go last year, that wasn't the case. 2023.
Mid-year.
There's still 7 stocks led it last. This year, it's getting better on that. There are other stocks joining the fray. Most of those are technology, right? Still in that technology world, which is, again, I love it. I mean, I love that we have this country that has all these great companies and all this great new innovation that helps the world, right? I mean, look at the Starlink satellites going up to help the world communicate. If you want to Google something that's amazing, you look at how many satellites we've put up since 2019, and this is Elon Musk putting these up and so that people in the Sahara Desert can get signals on their cell phone, right? And people in Antarctica can get it, and I just think it's all these, in the middle of the ocean. And all these things are just helping the world, the global world. It's going to help a lot of different areas. And it's from good old fashioned U.S. technology companies. And I love it. And so I do think there is room here to run even more because the technology just is never ending.
Yeah.
And I love it. I do, and I always pay attention to, Eli, you're right. There are times where, so what if the history says when you get a this type of thing, it has told us that it leads to that. It doesn't mean that that's the next step. We've had COVID. We don't know what's going to come from the COVID.
Or this experience is similar to 20 years ago.
Exactly.
That's the only time.
You can read, you can look at history to help you get guidance, but it doesn't always work out that way.
To further your point, there's a tweet by Bar Chart. Small caps are now underperforming large cap stocks by the largest margin since January of 2001.
Which I love hearing that too, because I think, we in our firm, we've started to add a little bit of small cap, right, to our portfolios, a little more.
Overweighting.
And I think it's a smart move. Historically going back to the Great Depression, so 100 years of data, more than 100 years of data. Well, yeah, about 100 years of data. We have small cap stocks are the number one performing sector in the market, and it's by a pretty wide margin if you go average annual return.
Not recently.
Not recently. So is it going to revert back to the mean and give us that opportunity again, or is it not?
And it's a similar underperformance right now between growth and value.
Right. Which I love value, but growth is just killing it. But I will say, it will revert back at some point, or give us one will flip the other at some point, regardless, even if technology continues to boom.
If we're talking long-term reversions, what we probably could or will see at some point, and no clue at the timeline that we will, international stocks would be one of them. So international stocks have massively underperformed United States stocks. That wasn't true all the way up to 2008, from like 1980 to 2008.
Right.
But since 2008, that has been true. So international stocks would be a contrarian play that could work out long term. small cap stocks
Yep.
have outperformed large cap stocks long term, not short term.
Right.
Value stocks
Value is underperformed.
has completely underperformed growth stocks. So
yeah, if you're chasing the losers, right?
if you're chasing losers,
yeah, you get those three, and you're probably going to be. I mean, you're eventually like a dead clock is right twice a day, right?
Yeah,
so
right.
you can always say, and I'm kind of the bear on the panel, but I'm not really a bear. I'm actually a long-term bull market person. I love the market, and I love our country's market, and I love what we do at Mach 1 to help people steer through that. But I'm a little more bearish now than I've been in recent past. But and we always say, like, if I keep being bearish, at some point I'll be right. It could be 5 years from now. But the point is, there is going to be, and I think smart investing where you continue to ride the wave of the growth, but you are aware that international small and value are eventually going to fight again. It's, these stocks aren't going away. These companies aren't going away. These are great companies. And small cap, every company that we have that we love that are large cap right now was at one point small cap. And that's why it's the largest or the best performing sector in market history, because every company goes through that phase, right? Everybody's a small cap before they're a mid cap, before they're, so it's a company doesn't get on the market as a large cap. All right. It comes in and small cap moves its way up. So, or I guess there probably has been some of the history, but most part it's small to large.
The hardest part about investing is what could be right as a long-term diversification play in the short term could look wrong.
Yeah.
So you could say, if someone was to be able to design a perfect portfolio, one that could withstand any environment with a 5% withdrawal rate, or something like that.
Right.
No matter what market cycle throughout history, you could withdraw 5% and it maintain its balance. That could be 40% international.
Right.
However, if it's 40% international over the last 10 years, your friends that were all United States investors
have outperformed
just crushed you.
The funny thing about that statement, which I like, is that there's keys to making even that type of investment work better for you in the long term, and it's just rebalancing the portfolio. So if every year your domestic stock, say you had a 50-50 split between domestic and international, I know that's not what we do, but say we did, and at the end of the year that 50% U.S. was now worth 60% of the portfolio, and the international was worth 40, and you sold the 60 to get down to 50 and bought the international to get back to 50. You did that continuously forever. At some point, you're going to be rewarded greatly because of the changing.
The hard part about that, and this is why investing is hard, is you just use the word at some point.
I know, at some point. It's emotional. If we take emotion out, and emotionally we can't stand. I had a client yesterday, and they're a conservative investor, and they're up 8% year to date, which is fantastic. The market, the S&P is up 18, I think, year to date. And she asked me the question, and she wasn't upset or anything. She was very happy with what she was doing, but she says, we're not making with the S&P. And I said, yeah, that's exactly right. But you're up 8% in a conservative portfolio. And it's about not always thinking about, you're never going to get it perfectly right? Let's say you're a conservative investor and the market's down 16% and you're flat. That's a much better picture, but we don't know. We can't predict what's going to happen tomorrow. Much less 6 months from now, a year from now. It's about wisely investing, using, Eli, what I love about our office here, and you've taught me a lot in the retirement analyzer stuff, the financial planning stuff. If clients come to see us, we can take a lot of this pain and emotion away because we do smart investing planning, and then you take the emotion out of it and you build portfolios, and none of this stuff, is it going to go this far? Is it this? It doesn't matter, right? I mean, you can participate. It does not matter. Catastrophic events matter, but we can't predict those either. Yep. And so you have to just, the less
the important
emotion,
thing,
the better.
The important thing is when deciding your own asset allocation. So for you specifically as an investor, being full and well aware of your risk tolerance.
Yeah.
And knowing that your risk tolerance will probably be changing as your life changes.
Yeah.
And accepting that I'm giving up some potential short-term returns so that my long-term returns can be steady.
Yeah.
No matter what market cycle I go through. Asset allocation is incredibly important in deciding that. So if you like this content, John, anything you add before I do this wrap up?
No, only thing I'll say is that 2008, clients that were very aggressive and believed they were aggressive, in 2009, they suddenly were no longer aggressive.
That's a good point.
So people can change their risk tolerance based on getting slapped in the face. And that's also a little bit dangerous because had those aggressive people stayed aggressive, they'd be great today. Does that make sense? But that's a long time to think about that. That's the only thing I'll add to it.
Yeah. So if you're deciding allocation and you say I'm aggressive,
understand the risk
and what that means
exactly
and what that could entail depending on the market cycle that you're invested. So thank you for joining us today on the Market Moment. We appreciate you listening. Thank you for liking, thank you for subscribing, and we look forward to having you next week on the Market Moment podcast.